Okay, assume everyone can see the mock exam paper. Right. Without sparing more time, we will start the session. Right. Thank you, Sarah. First question. It is related to La Vista. It's a private limited company. This is related to the investment appraisal and sensitivity analysis. Then what I will do, I will say this is relevant cash flow, which is not relevant cash flow, and which need to be recognized, and how to do the how to answer this particular illustration. This is relevant to project appraisal. It asks to do the sensitivity analysis, right? La Vista is a private company which is in the production of a wide range of goods. They are planning to invest in a new machine to produce a new product called Dyson. Now they are going to manufacture product called Dyson. The cost of machine is 40 million. 60% this amount is payable immediately, and balance can be paid in the first year of operation. That means year 0, there will be an outflow of 40 million into 60% means 24 million. Balance 40% means 16 million will be paid in the first year of operation at the end of first year. Why? Year 1, right? That means those are outflows. The machine is expected to have 4-year useful life and 0 scrap value. These are the sales volume over the period given. The selling price of Dyson is 200 per unit. This price is expected to increase by 6% per annum over from year 2 onwards. That means year 1, 200 price. 6% increment means 206%, then 224 rupees and 72 cents in next year, and balance year in 6% in fourth year, right? 6% increment there. Then you can calculate the revenue because you have the sales quantity volume there. You have to multiply it with the sale price after adjusting 6% price increment, right? The incremental fixed cost for year 1 would be 5 million, and this would increase by 3% per annum. Fixed cost you have to incur in year 1. Why 1? 5 million. Then it will be increased by 3% over next years. Over. Can't you hear? Because someone says he can't hear. Can't you? Am I audible?
Yes, we can hear, Nishant. We can hear.
Because some student says that there might be some disruption. Okay, right. Then the incremental fixed cost for year 1 would be 5 million, and it will be 5.15 in the second year. La Vista PLC beta is 1.5. Risk-free rate is rate in the market is 9%, and risk premium can be 6%. That's why you have to calculate cost of equity. Then you can get an idea. Capital asset pricing model, you have already learned how to calculate risk-free rate plus beta into risk premium. If we calculate simply, if you can calculate the value here, right? I will calculate it. If you want, I will quickly calculate it. If you calculate the rate, your risk-free rate is how much? 9%. 9% plus beta 1.5 into risk premium 6%. Then 6%, right? Then what is the value? 9% plus 9%, it will be 18% is your cost of equity. Cost of equity will be 18%. Can you remember the equation? KE, I mean cost of equity equal risk-free rate plus, I will take beta into market return. Okay, market return, or we can call risk premium, market return minus risk-free rate, risk premium. That's how it will compute. Right. Hope you have understood it. 18%. Thank you. The equity of the and La Vista's post-tax cost of debt 10%. Post-tax, that means after deducting tax shield, assume tax rate is not being given. Post-tax cost of capital is 10%. The cost of equity of the company is stated at 500 million, where the company maintained debt to equity ratio as 50 to 50. That means debt to equity ratio is 50 to 50. Then if someone asks to calculate if the company want to maintain, where company maintain, if your company maintain same debt to equity ratio, if you're going to invest in this particular investment, you have to calculate weighted average cost of capital. Simply, you can do the weighted average cost of capital. You can quickly calculate and let me know the answer. WACC equal cost of equity 18% into 50%, right? Plus cost of debt 10% into 50%, right? Simply, what is the answer? I need the answer quickly. We can finish it because someone says 13.2. Tilini says 14%. Yes, the answer should be 14%. 18% into 50%, 9. 10 into 50%, 5. 9 plus 5, it is 14. Right. Now you know the cost of capital rate. Assess the sensitivity of the above investment to changes in the selling price, fixed cost. Comment on the sensitivity of the investment to the change in variable. To do the computation, first to do the sensitivity, thank you everyone. To do the sensitivity analysis for first step, what you have to do? First, you have to give me a second. First, you have to calculate NPV. Now you know the cash flows, and now you can calculate the NPV. First, you have to calculate the NPV, then how to calculate the sensitivity. As an example, when you're going to calculate sensitivity of revenue, how to calculate sensitivity of revenue? Can you remember the things you have learned? Sensitivity to revenue. How to calculate it? Simply, it can be computed. Present, NPV, net present value, NPV divided by present value of revenue. Present value of revenue. You can show it as a percentage into 100. Okay, this is how it will compute. Right, thank you guys. Now tell me, when you why purpose of why we are doing sensitivity analysis? The purpose of doing sensitivity analysis is to identify the most critical factor which influence to success or failure of the project. Then how to identify the most critical factor? Once you calculate this sensitivity factor, there are some factors have a higher sensitivity factor, some factors have lower sensitivity factor. Which one has the highest impact? Highest sensitivity factor or lower sensitivity factor? Can someone give me the answer? Lower. Great. Now you have an idea. When lower factor means the small change in that factor will create a big difference. That means if the factor is smaller, that is small change will convert into the NPV as a negative NPV. As an example, assume sensitivity of revenue is 2%. That means if the revenue, present value of the revenue inflows change by 2%, your NPV, positive NPV will be converted into a negative NPV, right? That is the purpose of, that is the way of identifying most critical factors to the project. I think you have got an idea. Now we will see the answer. Okay, now you can see 280 this information available, the selling price, selling quantity, right? Then selling price 200, 6% increase, 212, 6% continuous increase. Then variable cost also there, it has been given as, I think yes, it is given and the incremental fixed cost also you can work out. Then if you are going to calculate NPV, investment you made at the beginning, 24 million, year zero outflow. That means 60% you will do at the inception, balance 40% in the year one, end of year one, right? Then you can get the contribution, selling price minus variable cost, that is the contribution, and multiplied by total number of units, then you can get the total contribution of the sales over 4 years. Then you can deduct the incremental fixed cost. If it is not incremental, you can't take it, right? It is not a relevant cash flow. Now, these are the cash flow, net cash flow. Then you have discount it by using discount factor, and you have to make an assumption. You have made, because it is not clearly mentioned in the question paper itself. They are maintaining current, they have maintained 50-50 debt to equity ratio, right? Then you can make a reasonable assumption. You can mention that I have assumed that company will maintain same debt to equity ratio for this particular investment as well. Then you have to calculate WACC. WACC, as we have computed, it is 14%, right? Then you have computed the NPV. 10.9 million is the NPV as per the computation, because within 2 hours we have to complete this discussion, and definitely we have to complete all very tough paper, because you have to attempt this one to get an understanding how to deal with this kind of situation, right? Right. Then sensitivity to selling price. You can calculate the present value of revenue. The present value of revenue is 211.98 million, right? DCF is correct. Yes, if you calculate present value of discounted cash flow, it should be 10.918 million. 26. Yes, it is correct. You can do the mathematical computation. DCF wrong at 14%. Give me a second. Okay, discount factor. So yes. Okay, discounted cash flow is incorrect. Then you can simply, how to calculate discount factor? Calculate discount factor. What is the discount factor? I think discount factor, they have made the change. Blunder. Give me a second. Yeah, discount factor is the problem. Yes. You can take discount factor. You have to calculate. I will work out it here. This should be 1 divided by 1.14, right? Year 1, right? Year 2, how to calculate it? 1 divided by 1.14, right? That is the second. Likewise, you have to calculate the discount factor, and then you can determine the cash flow. Then calculate the sensitivity factor, right? I think these ratios have been taken. Okay. Then you can present value of this cash flow, say, should be divided by the net present value of the project. So sorry, net present value. Assume these figures are accurate. 10.918 is the NPV. It should be divided by the present value of inflows, that means sales. Then it is says 5.15, okay, based on this information. The next one is the fixed cost. If we compute it based on the fixed cost, the sensitivity to the fixed cost, it is 66.83. Simply it means the fixed cost should be changed by 66.83. It should go up. If it is goes up by 66.83, the NP will be 0, right? Like kind of an analysis, it indicate that mean it should be changed by a significant proportion. That means if we look at about the revenue only should change by 5%. Based on this answer, 5%. That means 5% change in revenue may create the project indifference, right? You have to keep in mind. That is how sensitivity analysis should perform, right? Now the computation given how to calculate WACC and cost of capital. Selling price is the most sensitive factor, right? Then we will move to the part B of the question. Simply, even though it says 15 marks, if I have allocated the mark, I will give only 4 to 5 marks. This answer is not there at the C website. Right. Vitamin PLC. Vitamin PLC, the part B, Vitamin PLC imported a stock of raw materials in 1st of March 2022. 1st March, you are importing material and the payment is due on the, remember the date. Date is due on 31st of May 2022. The payable is $200,000 US. The company expects the dollar to appreciate further in future and consider hedging. There are two techniques they are going to use. First option, a forward contract, right? They are going to enter into forward contract. Vitamin can go for forward contract at a 3-month forward rate at USD1 at 275. Okay. Now at the moment, current spot rate they have been given at 260, but you have to pay on 31st May 2022. Option 2, Vitamin is interested is buying USD 20,000 option with the strike price of 270. The cost of an option is 100,000. The option means you agree to buy, but there's no, you can either, you have an option to exercise or do not exercise the option, but you have to pay a minimum amount to secure the contract. Then if you want to buy these total contract value is 200,000, then you have to buy how many contracts? 20,000 option each. Then 10 contract you have to buy at $100 per contract. That means you have to purchase 10 contracts at $100, right? Then that means $1,000, USD 1,000. That is the cost of option purchasing $1,000, right? Then on 1st March 2022, Vitamin has decided to go ahead with the currency option instead of forward contract because it is cheaper than by going for a forward contract. It is 275. Anyway, it is not a feasible option. You can eliminate option 1. You will go with option 2, that is going with options. Forward contract in order to hedge the foreign exchange risk, where the spot rate was 260 at the moment. At the beginning, 260. However, if the spot rate 31st May 2020 is $1 equal to 265, Vitamin does not wish to exercise the currency option. Why? If the option exercise, you have to buy at dollars at 270, right? Then if you buy dollars at 270 for settlement of $200,000, then what would be the total cost? Total cost would be $200,000 US into 270. You have to spend 54 million. Agreed? 54 million. But on the date, if you are not exercising the option, you have to settle the contract because at that date, contract you have to settle this 200,000 contract at 265 each. Value will be 53 million. What is the gain on this arrangement? So will you be sharing this answer with us? Yes, we are sharing. Arun will share with you. It will be uploaded to the Sri Lanka website. Also, we can share it with you. 53 million. Now 54 million minus 53 million, that is 1 million gain is there. Is it exactly 1 million? The difference exactly 1 million. Can you say like that? No. Why? Then what is the gain? What is the gain? Because you had to pay at the inception. Yes. At the inception, you have bought 10 contracts, right? You have bought 10 contracts at the beginning. That means 1st March 2022, that value is $1,000. How much you have paid? At that date, you have paid 260. Then you have paid 260,000. 260,000. That is the cost. Here you will get a gain 1 million. 1 million gain. Then 1 million gain minus cost of the option 260. Since you have not exercised this option, you will gain 740. Your net gain 740,000 is your gain. You will gain 740,000 as a gain. Ritma or Ritma. Okay, assume Ritma. Okay, Ritma, I don't know. Anyway, this name is familiar with me. Right. Okay, we will move ahead with the next question. Am I fast? Oops. No, right. Thank you. We will move because I know the situation, guys. Don't get upset or don't get confused. Please concentrate. And I know there are so many disturbances, even myself also. There are so many disturbances, but I have prepared to listen and I have prepared because the external environment conditions are not so much favor to everyone. It is not for me, it's not for you, it is to the entire country. Therefore, we have to complete this one. This is the task you need to complete. Therefore, don't get demotivated and we have to complete this anyhow. Pass this exam and become a member. Right. We will move to question number 2. Now, look at this option. Read. Master of PLC is evaluating 2 mutual exclusive projects. You have no mutual exclusive, mean if you accept one project, you have to reject other one, right? Mutual exclusive project, each project requires an initial investment of rupees 70 million. Both projects require equal amount of investment, 70 million. No electricity, please ask to share this tomorrow. Yes, guys, I know that there's no electricity now. There are some power cuts, there are some interruption. Definitely we will share this one. Definitely we can share this one. And if I can put this into the chat, is it okay? Aruna, is it okay if I drag this into the chat or put into the chat? I can share the answer here itself. Right. Anyway. Time to time you can hear there might be some disruption due to the internet.
Sorry, sir.
Aruna, I said that.
Hello.
Hello, Aruna, can you hear me?
Yes, sir, I can hear.
Okay, Aruna, now students are asking whether we can share the answers. We can share this one, right?
Yes, we can share. No problem. We can share. We will upload in the website also.
Okay, then fine. That's
yes.
Fine.
Okay.
Okay. Give me a second. I will in the chat, then it's better. Give me a second, guys. I have put in the chat. Right, you can download the answer, mock exam answer. I have put it. I have uploaded to the chat. Give me a second. Now you can see. Right. Okay, we'll come back to the question. Right. Project A, net cash flows given in millions. Right, net cash flows given in millions. The funding strategy is as follows. Okay, they have given the funding strategy. The current dividend payout ratio is 50%. Mark it out. Current dividend payout ratio, they have maintained over 5 years' time, 50% dividend payout ratio. Right. And company can reduce this up to 20% as they need to maintain at least 20% dividend payout ratio to comply with its dividend policy. Right, company over the period, they have maintained 50% dividend payout ratio, and they have an option. They can pay with right. The balance can be met through the debt finance at a rate of 12% per annum, but the current gearing ratio should be maintained. Current gearing ratio, if you look at about debt equity 300, debt 40, that means 60 to 40 is the ratio. Well, you can mark it down. Current gearing ratio 60% equity, 40% debt, right? The profit made during the financial year 31st March 2020, 80 million. That means that 80 million included in the equity, right? Now you need to decide whether are you going to distribute 50% out of it, then you have to fund the entire thing from the market, 70 million. Either you can reduce it to 20%, that means you can save 30%. 30% dividend saving mean 80 million into 30%, because if you pay 50% dividend, then 40 million you have to pay. If you are going to pay 20% kila kyanne, then it is 16 million. That means you can save 24 million for the investment. Then balance, because your total investment requirement is 70 million. If it is 70 million, balance 46. Okay, balance 46. I will say, if equity 24, debt financing 46 million, then can you maintain same debt to equity ratio? 46 to 24, you can't maintain. Currently, equity should be 60, debt should be 40%. Then you can't maintain that ratio. Okay, I will show you the answer. Right. Okay. Required funds 70 million. Your profit is 80 million. Funds that can be raised through a reduction in dividend payout. That means minimum 20%, then 30% you can retain. That means you can earn 24 million or retain 24 million. Then total investment requirement 70. If you retain 24 from finance 24 from equity, balance 46. Finance where? It has to be financed through the debt. Debt financing 46 million. then ratio will be 46 to 24. Existing ratio 40 to 16, 40 to 60. Then if we want to maintain same ratio, the debt financing should be 42 and equity finance, sorry, debt to equity ratio, debt financing should be only 42. Then there's a gap 4 million. Okay, 4 million deficit is there. Then are you going to raise equity capital? No. Is it sufficient to call equity capital 4 million? It is not. It is not. Then you can suggest different alternatives you can suggest. And you have to explain what are the repercussions, right? What is the requirement? Analysis how master could finance the initial cost of the project that is selected. Then if they are going to finance this one, they have an option, right? They have an option. They can, they can use 24 million, but 46 million, it is a marginal amount. You can borrow it from the borrowed banks. On the other hand, previously, now we have had a pattern over last 5 years, 50% dividend payout. When you are not paying 50% dividend payout, the investors might get upset, right? They will get upset and it will have a direct impact on your share price. When you are going to curtail dividend payment, then your investment may not be get attractive, right? Those are some indications. Then on the other hand, this investment, if you have to see whether this investment create a positive investment or positive inflow or net present value is positive or not, right? We can see what you have to do. Now, as I have mentioned, 30% reduction in dividend payout, it will impact the share prices. That is our main concern, right? Sorry. Then now, if you want to maintain the same debt to equity ratio, the 4 million it's a small amount, right? Then there's no mandatory bond to pay, but it will be going against with your dividend policy. Minimum 20%. Then if you can declare 15%, here says 15%, you can fund entire amount for 28 million equity, balance 42% from debt. Then you can maintain the same gearing ratio. But ultimately shareholder, because it will helpful to make increase shareholder wealth. You can argue in both sides. If you pay less dividend and retain to have an organic growth, risk will be lower, right? And you don't have any fixed commitment to repay. You can have an organic growth. But on the other hand, shareholders will be dissatisfied. Your share price will be collapse. Okay. When the share price collapse, it will impact on the shareholders' wealth because number of shares into market price of the share, then share price, market capitalization, share price will fall, right? That need to keep in mind. Then you have to do the now second part of the question says evaluate which project should be financially acceptable by Mastero, where the cost of capital is 16%, by explaining the primary objective of the shareholders. Now you have to discount these cash flows, present value of these cash flows at 16%. And okay, anyway, don't worry, CA Sri Lanka will upload this answer to the website. Then you can see it and they will email. Okay, please don't chat here and again, then people get distracted. First, before looking at the answer, First, understand the concept. How are you going to attempt this particular illustration? Now, first part we have done. Now, second part, easily you have to calculate discounted cash flows, net cash flows over 4 years, and outflow will be 70 million, then calculate net present value. Okay, net present value computation, I'm not going to do that because it has been done. And you can see net present value, you can suggest different component. This is the net present value component. Project A, NPV 4,370,000. Project B, 4.638. Which project you will select? Which one? If you want to maximize the shareholders' wealth, which project you will select? The project which has the highest NPV to be selected because initial investment are same. Guys, tell me, assume if your initial investments are different, which investment you will select? How are you going to determine that? How are you going to determine that? Yes, you have to use profitability index. You have to use profitability index. Based on profitability index, the index which has the highest P profitability index should be selected, right? Then assume if the duration is different, what are you going to do? Duration is different. What you have to do? Annualize, exactly. Thank you, Damika. You have to calculate annualize NPV, and then you have to determine the best one. Right? In project B, ultimate objective is to maximize the shareholders' wealth. You have to select project B. You have to select project B. That is the answer for part B of the second question, part of the question. Because your objective is to maximize the shareholders' wealth. You have to explain a little bit the ultimate objective of the shareholders. Objective is to maximize the shareholder wealth. Then you have to give some, assume if the period is different, how are you going to make a decision, right? If the period, if the initial investment is different, how are you going to make decision? Likewise, you have to explain, and you have to explain the project B should be selected. I am not going to explain. I am a very simple person, but here it has given a long answer, but summary, snapshot of this answer. The objective of a financial management is to maximize the wealth of the shareholders. Therefore, when we are going to maximize the wealth, you have to select the project which has the highest NPV. Project B has the highest NPV over project A. Therefore, project B should be selected in order to maximize the shareholders' wealth. That is the answer. Clear? Clear cut. Hope that is done. Right. Then part B. Now an investor is evaluating below information in relation to FTPLC. Right, FTPLC. Dividend, earning per dividend payout ratio is given. 55%, 60, 50, and right, 55, 60, 50, 40, and 50. Now you can calculate what is the dividend per share. Here dividend per share would be 1 rupee, and here it is 55, 1 rupee and 21 cents. Here it should be 60%, it is 1 rupee and 38 cents. Okay, likewise, you can calculate the dividend per share, DPS. Dividend growth rate for 2022 would be 0.5% less than the average growth rate thereafter. That would be 1% per annum for next 2 years and will remain 1.5% per annum thereafter. That means what you have to do. you have to calculate what is the dividend growth rate. Calculate right. Then you have to calculate dividend per share and dividend growth rate. You have to calculate how to calculate dividend growth rate. First, you have to type here what is the dividend in first year 2017. This is year 1. It should be 1 rupee and 21 cents. The next year, likewise, you can calculate. I will take the last year. It is 1 rupee and 30 cents. Right. Yes. You can calculate dividend growth rate. What is the growth rate? You can simply calculate dividend growth rate. Growth rate will be 1.81. 1.3 divided by 1.3 divided by 1. How many years? For 5 years. Growth will be there in 4 years. Then you will receive the growth rate of 1.81. 1.81 as a growth rate. Yes, 1.82. Simply 1.82, 1.81. That is the correct answer. Growth rate is 1.81. Right. Then give me a second. Draw. Give me a second. 1.3 divide by 1.1. -1, then you will get the growth rate. Right, it is 1.81 is the growth rate. Guys, how to get 1.21 and 1.3? Lamai. Earning per share 2 rupees and 20 cents. Dividend payout ratio 55%. That means you will pay 2 rupees and 20 cents into 55%, 1 rupee and 21 cents. Right. Here you have earning per share 2 rupees and 60 cents. 50% means 1 rupee and 30 cents you will pay as a dividend. Then you can calculate the geometric mean. Then you can easily calculate the answer at 1.81. That is so simple. Why 4 years? Lamai, there are 5 years, but growth should be there in between 2 years, no, n-1. Now assume there are 2 years, 2017-18. You want to look at the growth in between 2 years. Not here, can you see a growth in here? No, you can see the growth in between 2 years. How many, even in number of years? 5 -1, 4. That means growth will be there over 4 years. That's why I have taken 4. These are simple things which you have already learned. I thought you have already know about that. But anyway, then I will move to then 1.81. Then 2022, the growth rate will be 0.5% less than that. That means it will be 1.31, right? 1.31 in 2022, right? Thereafter, it says growth rate will be 1% per annum for next 2 years. Next 2 years mean 2022, 23, 24, it will be 1% growth rate. Thereafter, remaining years, 1.5% per annum. That is the terminal value. Investors also expect an additional risk premium for 3% compared to the 13% return given by other companies in the same industries. That means 13% plus 3% means 16% is the discount factor required rate of return of the investors. The market price per share is 9 rupees and 10. Advise whether an investor should invest in the shares of FTPLC. What you have to do? You have to calculate present value of future cash flows. Future cash flows are dividends that you will earn. Calculate the present value of dividend. We see whether it is greater than 9 rupees and 10 cents. Okay, I will show you the answer quickly, and you can understand how to deal with that. This is how dividend per share we have obtained. Earning per share 2 rupees and 20 cents multiplied by 50%, 1 rupee and 21. Likewise, I have computed this one, dividend per share, then calculate dividend growth rate. Right? You can say D0 plus D1 equal D0 into 1 plus G. Likewise, this is how it has been computed, and this is the dividend growth rate, 1.81 historical dividend growth rate. In 2022, growth rate is 0.5% lower than it, 13.1. Required rate of return 13% and additional risk 3%. In final investor point of view, favorable without 3% won't be, because when the rate is going up, the present value of future cash flows will fall, right? Then if you take 13%, present value of future cash flows will go up. It won't be unfavorable, it will be favorable to the investor, right? That means he's looking at whether this company is relatively higher risk than other companies in the industry. That's why they expect additional risk premium than the market. Okay, other entities. That's why instead of 13%, they expect 16%. Now, in 2022 is the immediate year you will receive. That is today. Today, you will get the dividend. I will assume that is cum due. Cum due means you will receive the dividend today. This is how we will calculate dividends, because 1% increment is a small amount. The growth rate 1.31. First dividend growth rate is 1.31%. Then 1.31 into, you can look at the dividend you may earn. Here 130 into 1.31 means 1 rupee and 31 cents in year 0. 132, 133, 134, and then you have calculated the terminal value. Terminal value and discounted value of share 10.56, right? 10.56, market price is 9.1. Then that means value of share. This should be this comment should be eliminated. This should be purchased. This should be purchased, right? The investment should be purchased because market price is greater than, value of share is greater than the market price. That means you will get more return than the market price. That means share price is underpriced. If you invest, you can get more than 16% return. Therefore, you can conclude it should be purchased, right? You can see the discounted cash flow computation separately also. I have put it. Yes, this is the working. This is the way of computing it, right? This is contradictory. This should have been removed because this is the suggested answer. This should be removed. This is the one. It is recommended. Recommend to purchase the share. You can see 1 rupee and 31 cents, 132, that is the immediate year. Then next 2 years, you can say 2 years it is growth rate and 2024, and terminal value also being computed, and growth rate is 1.5 over the period. Then this is the value of the share, right? It has recommended to purchase the share. When you're going to do this similar kind of computation, what you have to calculate, you have to calculate present value of future cash flows. Present value of future cash flows. Then if the present value of future cash flows greater than market price, the decision should be you have to purchase the shares, because the share market price of the share being undervalued. You have to buy the shares, right? Then we will move to the next question. Question number 3. Question number 3 is the bigger question, I think. Yes, it is. Right. We will look at question number 3. Based on the common present, this information given, I will tell you, when we are going to calculate this information, the most important thing, current debt to equity ratio, right? Current debt to equity ratio is the most important information. No any other information is applicable, right? We'll read quickly. FLI had their recent board meeting and it was decided to grow the company via an acquisition. That is, you are going to acquire, and you are going. That is how you are going to expand the operation. One of the reasons for this is to diversify the business due to challenges the industry is facing, because you can remember, you are in insurance industry. They identified 2 target companies in the same line of business. Both these companies have a strong and well-established client base and into general insurance. FLI prefers to maintain target gearing ratio of 45% as the banks impose debt covenant of 50% gearing. That means 45% gearing ratio, debt 45%, equity in how much? 55%. Okay. Safety Life PLC, this is the first acquisition target entity. Profit before tax for the financial year ended 31st December 2021 is 1.5 billion, which is expected to grow by 5%, 4%, 4%, and 3% per annum for the next 4 years. Profit before tax growth you have to look at. Cost of sales is rupees 1 million and expected to grow the same rate as profit. The incremental working capital requirement can be estimated 30% of the cost of sales. Now, you have to estimate. In the inception, it says 1.5 billion, it will grow up by 5%. Cost of sales also increased by 5%, and 4%, 4%, and 3% respectively. And working capital requirement is 20%, 30% of the cost of sales. Capital expenditure will be 1 billion per annum from 2022 and will grow at 3% per annum next 3 years. Now, while reading this information, you will feel that they are asking to calculate what? Free cash flow basic valuation. Can you remember? Profit before tax, account and depreciation you will add back, and capital expenditure you will deduct, taxation you will deduct, and cost Then you will calculate incremental of free cash flow, right? Now, while reading, you can remember it. Assume that, already given, effective tax rate would be 20% on profit before tax. You have to pay profit before tax 20%. Assume that free cash flows will grow 4% per annum from year 4 onwards. After 4 years, it will grow up by 4%, right? 4%. Debt to equity ratio of the company, balance debt to equity ratio is 2 to 5. 2 to 5 is the debt to equity ratio. Then what is the debt to equity ratio you are going to maintain? You have to maintain your debt to equity ratio is current debt to equity ratio of the company. You have to calculate what is the debt, what is the equity. It is very low amount. Your company debt to equity, I will show it to you, and then you have to calculate your current debt to equity ratio. Debt to equity ratio is 2.5%, equity beta is 1.3 times, and the market premium can be based, assumed as 5% with the risk-free rate of 6%. Now you have to calculate what is the equity, cost of equity. You have to calculate by using capital asset pricing model. And remember, the company, your parent company, that is FLI, has to adjust cost of equity based on their current gearing ratio, right? Therefore, you have to calculate unlevered beta and re-gear based on the company debt to equity ratio, right? FLI wish to maintain the same gearing ratio after the acquisition, and discount rate should be calculated for current debt to equity ratio of this particular company 2 to 5. You have to adjust it into what? Target debt to equity ratio at the prevailing debt to equity ratio of your company. Post-tax debt cost of debt is 10% per annum, right? That is there. Then next one, BDO Life PLC, same information. I'm not going to read it. Same information. Same type of information. You have to recommend an appropriate valuation for the two target companies based on the discounted cash flow method. Appropriate valuation. Then you have to calculate discounted cash flow method, and you can calculate the present value, and based on that you have to evaluate the value of the company. That means NPV computation you have to do. Okay, I will show you the answer without taking much in your time. Look at target company levered beta 1.3, debt to equity ratio, debt to when equity 5, right? Unlevered beta assume X, 1.3 is the levered beta. Then can you remember levered beta should be converted into unlevered beta? Then this is unlevered beta is the X. This is the levered beta is 1.3. X into debt, 1 minus T divided by equity. Now when you calculate X is unlevered beta, we call asset beta is 0.9848. 0.9848. Now what is your company debt to equity ratio? If you go to the common pre-scene, you have a very important information in balance sheet. Right. Your equity, this one, 9.936. That is your equity. Your debt. What is your debt? Loans and borrowings, because insurance contract liabilities has the insurance asset in the insurance industry. Therefore, you have to take interest bearing borrowing. It is 2.852. That is the amount you have to take, because this is the insurance industry. You can see insurance contract liability. On the other hand, you can see financial investment and insurance receivable is there. Okay. Therefore, you have to take this one, loans and borrowings, right? Loans and borrowings, 2.8. The debt is 2.852, equity is 9.9. Now, here it's mentioned, tax is 28.58, that is the effective tax rate. Then levered beta, you have calculated 1.1867, because this particular company has a high level of equity compared to this particular company. Safety Life PLC has a higher debt than FLI. Therefore, their cost of equity now you can calculate risk-free rate 6%, right? Beta 1.167 into 5% is the risk premium, 11.93. 11.93. Cost of debt 10%. Now you have to calculate debt to weighted average cost of capital based on the debt to equity ratio given here. Right? Debt and equity both are there. Therefore, once you calculate weighted average cost of capital, it is 11.5. Now, this is the important information. Profit growth 5%, 4%, 4%, and 3%. At the year zero, initially it says 1.5 billion is the revenue. It will grow up by 5% in year one, 4% in year two, 4% in year three, 3% in year fourth year. Depreciation and amortization, you can easily take it from your balance sheet. Sorry, it has been given, I think. Give me a second. Depreciation and amortization. Here, depreciation and amortization expense is 800 million for the year, and it will be grow at 2% per annum for the next 4 years. It's there. Therefore, you can add depreciation, right? You can add depreciation. Cost of sales will go up by 5%. Then incremental working capital, 5% of the is it 5%? Yes, 5% or 3%. Working capital will be here somewhere 30% can be estimated 30% of the cost of sales. Then take the incremental working capital requirement in year by year and calculate it. Assume taxes will be paid in the same year which it arrives. Then you have calculated the free cash flows. Then free cash flow at 6th year, which will be grown at the continual rate, that means terminal value. How to calculate terminal value? Cost of weighted average cost of capital is given here at the rate 11.5. When you are going to calculate terminal value, how to calculate it? Free cash flow at 4th year into 1 plus G divided by WACC minus G. Then you can easily, that means 826 into 1 plus G divided by weighted average cost of capital minus growth rate. Then easily you can calculate what you can calculate. You can calculate terminal value, and terminal value should be discounted to the today's value from the discount factor at 4th year. This one, right? Okay. Okay, I'm a little bit fast because there might be power interruption in 9 o'clock. That's why we need to finish it off. The terminal value calculation, and we have determined the net present value 9.83, right? You can see the way of computing terminal value at the end of year 4, right? Then 826 into 1, that's simply 826 multiplied by no, they have taken the cost of sales in order to explain what is the incremental change in the cost of sales, right? Incremental change in the cost of sales. Otherwise, if it is being double deducted, this one will be negative again. Because profit before tax, in order to get the incremental cost of sales, that's why they have taken this one. Right? Clear? R minus G. What is the meaning of R minus the R mean cost weighted average cost of capital, interest rate, minus is the growth rate. Can you remember in dividend growth model, how to calculate? I will simplify this one. Dividend growth model, when calculating cost of equity, how we will calculate it? 0, B0 into 1 plus G, right? Divided by, sorry, this is price, right? KE minus cost of equity minus growth rate. That you have already learned. Clear, Lamai? Is it clear? Lamai, profit before tax, it should be a spelling mistake. It should not be a profit before tax. It is a revenue. Right. The profit before tax for the year, sorry, 1.5 million. It's 1.5 million. It's grown by 5%. We should not add cost of sales. Your profit before tax 1,1575. Incremental working capital 350 minus capex 1000 and tax is 350. $1,575 plus 816 minus incremental working capital 350. තමයි මෙතන අඩු කරලා නැහැ. ඔයාලා calculate කරලා බලන්න. ඔයාලා right. Look at it. Profit before tax 1,575. You have to add the depreciation, right? Then you have to deduct incremental working capital, capex, and tax. Then you will receive free cash flow. That's how it has been taken. The cost of sales figure, they have been taken in order to take the increase in cost of sales and in order to determine the incremental working capital. That was the reason. Otherwise, there's no meaning of giving the figure here. Okay, you can, when you're going to calculate free cash flow, profit before tax plus depreciation and amortization plus minus incremental working capital minus capex minus tax, then free cash flow. Now you got it, right? Thank you. I got confused. Don't confuse me. Right. Anyway, now you have calculated the value 9,843. Same apply for the BDO Life PLC as well. BDO Life PLC. Target company levered beta 1.6. Definitely, this particular company gearing is lower than them. Then you have calculated. We have already calculated ungeared beta in earlier situation. The company levered beta we have calculated here. Cost of equity 12.025. WACC 10%. Cost of capital same as 11.57 as earlier. You can say the same information like this. Free cash flow terminal value calculation done. NPV 11,320. 11,320. This is how they have computed free cash flow basis valuation. You have evaluated both options and both have positive NPVs. Positive NPVs. Similar computation, therefore, no need to discuss it again and again. Right. Then these are the valuation based on free cash flow basis. Part B of the illustration exam paper, I am not, because you have done this more than this type kind of question, that's why I am quickly should go about negotiation. Negotiation, we have to have a minimum and maximum range, right? Minimum and maximum range for the valuation. Now this free cash flow basis valuation says about the future potentials, right? It look at about whether company can generate future revenue. The cash flows you have considered include the future growth of the business. That means that is the upper limit. Then you can look at the net asset basis valuation. The net asset basis valuation reflects the historical earning, not the future earning. Then the minimum will be your net asset basis valuation. You have to negotiate the price in between your net asset basis valuation and the free cash flow basis earning based valuation. The free cash flow is the earning based valuation. Then your answer should be other valuation techniques. You can go to net asset basis valuation, that is historical valuation, and you can compare it. You can keep it as a threshold minimum, and you can take the maximum as your free cash flow basis valuation, right? I think you are very much clear. Other asset based valuation is given because balance sheet regard as the providing objective fact concerning the ownership of asset and responsibilities and creditors, and this says about historical values, right? Right. That is the explanation about market value. Since both companies are listed, there is an established market value. Okay, other technique is market value. Therefore, fair value of the net asset can be taken because both entities are listed in share market, right? Minimum and maximum comparison you can do. Okay, part C. Comment on business implication and any other critical qualitative aspects that would like to highlight FLI's management for success of the acquisition. Remember, when you're going to acquire a business, well-established business, there might be, you have to look at, there are some situations where the financial information, financial or relationships can be manipulated, right? It can be manipulated. Therefore, you have to look at that. And the cultural conflicts might arise when you acquire a new company, right? There are some in general insurance, if it is not there in your portfolio, you will be entering into a very profitable investment, and it is the industry which you are known, right? Therefore, it is not the unrelated diversification. It is a kind of a related diversification. When you move into a related diversification, you know how to do the business. You know, technically know how, right? Therefore, there's a less probability of failure when you enter into the same industry, but you have to take care of, because there are some businesses which are driven by personal related contacts. Sometimes some contract might be manipulated, some insurance arrangement might be, some connection might be manipulated. Therefore, you have to keep track on that. Discuss and recommend appropriate funding method for the acquisition, assuming the requirement is 10 billion. If the requirement is 10 billion, based on current gearing structure, now debt to equity ratio, debt is very minimal, equity is high, right? You will be, if you go to equity funding, right? Equity funding, your debt to equity ratio will further fall, right? Theoretically, equity financing is the highest cost of financing arrangement. Theoretically, why? For the residual interest, they are entitled for the residual interest. Therefore, they are equity funding, but risk will be minimized because there's no fixed commitment to repay. The debt funding, it will increase, gearing will increase, but since company is a low geared company, you can get some sort of leverage because you have the capacity to get additional leverage to your company, right? Or otherwise, you can go with mixed financing arrangement, debt to equity, both debt and equity financing might be suitable. Since company has not borrowed much, you can borrow more, but suitable to go ahead with the preferred debt to equity ratio you can follow. Those are the 3 options you can recommend. We will see the answers: equity funding, debt funding, and mixed financing arrangement, right? Okay, debentures. Okay, next one. This should be part E. It is not. FLI is planning to conduct a debenture issue to settle its debt obligation due to 1 year's time. Their borrowing position is as follows. 500 million, 14% interest rate, right? 200 million, 10.5. 700 million, PLR plus 3%, 1.4 billion, PLR plus 4%. This is the total borrowing, 2.852. Okay, this is the debenture you are going to issue. PLR is the prime lending rate, currently stand at 11%. And 11% now, 11% plus 3%, which is 14%. 11% plus 4% means 15%. Now you can range the value. The financial advisors recommended below tenors and interest rate for the issue. Tenor 3 years, fixed rate 13.5, floating rate PLR plus 1.8. It will be 12.88, right? 5 year, 15% is the fixed rate. Floating rate will be PLR plus 2.5. It will be 13.5. 7 year, it is 16%. PLR plus 3%, that will be 14%. Right. Recommend optimum structure for a debenture issue considering the existing interest rate and financial advisors recommendation You may decide not to replace some of the debt obligation if the conditions are not favorable. Now, as an example, these are debt obligation, right? This 200 million, if you look at 10.5, or around 10.5 the borrowing cost. All these financing options, shall we calculate the value here also? We will calculate, then you will okay, this one PLR plus 1.8 mean it should be how much? 12.8%. Well, I hope you can see it. This one 12.8, right? PLR plus 2.5 mean it will be 13.5. 13.5%. Right. PLR plus 3% mean this should be 14%. By looking at this option, floating rate is more favorable in all the instances, rather fixed rate. Now look at these rates. You have borrowed 700 million for PLR plus 3. That means this should be 14%. 14%. PLR plus 4% mean it should be 15%. Now you need to determine which facilities to be replaced with other facilities. First one, 14%. You can replace with 3-year tenor bond because our 5-year tenor bond 13.5. This 500 million you can replace because current interest rate is 14%. This this 200, sorry, you should not replace it. Why? Their finance cost is very minimal. It is very low, very much cheap. Right? You should not settle this 200 million. 700 million, 14%. Yes, you can settle with either this one or 3-year or 5-year bond you can issue at a floating rate is preferred. This one definitely need to be settled whatever the tenor is preferable because currently you are paying 15%. Therefore, what is the recommendation? You should not settle 200 million borrowed at 10.5. Done. 500 million plus 700 million, 1.2 billion should be settled with 3-year or 5-year bond. This 1.4 billion should be settled with either one of whatever the option at floating rate is suitable. That is the recommendation. Right. We will see the answer. We will see the answer. Right. You can see floating rate assuming PLR 11%, floating rate 14%, 500 here 10.5, and then you should not settle the 200 million facility. Right. You can suggest the tenor 500 million 13.5 fixed, suggest a 3-year, 700 million 13 point fixed, go ahead. If you can fix it to the given period based on this scenario, if you can fix into 13.5 for 3 years, but here they are not going forward. If you're going to increase the period, the rate will be much higher. But if you are able to fix it 13.5, fix all the facilities for 3 years if it is possible. Right. This should be 3 years, not 4 and 5 years. Right. That is the answer. Then final question. Evaluate the suitability of debenture financing compared to right issue, like a debt financing and equity financing. Debt financing, you have the fixed commitment, you have the settlement, right? Debenture, your gearing will go up, then it is not, if you are a highly geared company, It is not a suitable investment option. You can see the answer. Debenture, the gearing ratio stand at 22.3 and there will not be a change if part of existing debt is replaced with the debenture. Okay. If you borrow from the debenture, gearing won't change. It would give an interest rate advantage as well as an advantage from the increased tenor. Right. That is about in order to, if you're going for right issue or going for settling debt from the another debt, restructuring. Right issue improve your gearing situation because you will collect the cash and settle the debts. But based on the present scenario, right issue I won't recommend because your gearing situation is 22.3. Better if you can convert this debt into a low interest cost option. That is the recommendation. Right. Okay, these are the action verbs and all, and you can see the pre-seen information. All right, that's the end of mock exam paper. I have a little bit fast because there are some disruption through the internet, and that's why I have quickly gone through. Hope you have understood. Guys, any questions before concluding the session? Any question you can put into the chat? Okay, no question at all. Guys, in the final thought, because this is not a big issue, because we need to prepare for more more worse paper. I will say not worse. They are more comprehensive paper than this, but you have to practice. Practice is essential. When you practice more and more questions, then it any areas you need to highlight. Therefore, definitely appraisal, project appraisal area we have to look at, and what are the suitable determination of suitable financing strategy and hedging of foreign currency risk and the risk management aspect, because in the current environment you have to look at. Those are the areas you need to look at. Weighted, how to calculate weighted average cost of capital and cost of capital concept are very important, and the project appraisal or investment appraisal. Right, guys, thank you for joining today's session. I have been a little bit fast because we need to familiarize with the content and we have to quickly run through, and this because you have to answer within 3.5 hours or 3 hours paper. You have to quickly familiarize with the paper, and yes, some values are wrong, but steps can, yes, they can. If it is mathematical wrong, then they will not consider. And but the steps you have followed is accurate and the concept is accurate, they will give the mark. Don't worry. Right. I can't say it is a selective learning. No. You have to look at all the syllabus and you have to practice more past papers. I will highly emphasize practice more past papers, then you will familiarize with the exam content. Then you can easily pass this exam. Okay, anyway, in the final thought, wish you all the best in your final examination. Do it with the flying colors and complete it. I know this is a very difficult time. You will be able to complete it. Thank you for joining, because I don't know whether I have introduced myself. I am Nishant Adhikari, and we will share the information. We will share the answer with you. You can go through and do the computation, do the paper again, and practice more questions.